Getting a pension annuity is one of the few ways you have to secure income for the rest of your life. No matter how long you live for or how the stock market performs, your annuity income will remain the same. For those with a low threshold for investment risk, this makes it a potentially suitable option. Typically, you can take 25% of your pension tax-free and use the rest to buy an annuity. It's not necessary to take your pension all at once, and you don't have to choose an annuity if you don't want to. A mix of retirement options can be used to meet your needs. There are a variety of insurance companies that offer annuities, and the rates vary. The pension providers you are currently with may not be offering you the best rate, so you can compare quotes from other providers. Your annuity cannot be changed or cancelled once it's been set up, so choose wisely. The rules regarding pensions and taxes may change, and benefits may vary from person to person. How much income could you get? Many different factors will affect how much annuity income you can get. The size of your pension. Your income is likely to be larger the more of your pension you use to purchase an annuity. However, it's possible that you won't want to lock your entire pension into an annuity. In that case, purchasing several annuities gradually could be a strategy to take that into account. Annuity rates at the time you buy. The amount of income you could receive is determined by an annuity rate because they are correlated with gilt yields, the yields on government bonds, which are highly responsive to changes in interest rates, that is constantly fluctuating. You often receive higher annuity rates when yields are higher. Rates may be lower if they are low. Your age, health and lifestyle details. You tend to get a higher annuity income the older you are. If you disclose unhealthy lifestyle choices or underlying health conditions, it can also lead to more income, factoring in the lower life expectancy. Even confirming details like how much alcohol you drink, your height, your weight could help you qualify for an enhanced annuity. We'll go into a bit more about enhanced annuities later. Annuity features and options. When you set up an annuity, you can normally choose if your income will rise over time to receive monthly or annual payments, and if your spouse will continue to receive payments after your death. Options include single life annuities. Your annuity income will pay for the rest of your life but will stop when you die. A joint life, your annuity income will continue to be paid to your beneficiary, usually your spouse or your partner, if you pass away. A guarantee period, your income will continue to be paid until that guarantee period ends, even if you die beforehand. Value protection, the original amount that you use in exchange for the annuity, minus any income paid, will be paid out as a lump sum when you die. Index linked, this is where your annuity income will increase in line with an index such as RPI, inflation. Increasing income, you can set your income to raise by a fixed amount, typically 3 or 5% per annum. Do you want to take tax-free cash? Normally you're able to withdraw up to 25% of your pension as tax-free cash, but you're not obliged to do so. For instance, some people might prefer to devote their full pension value to increase their annual income. Others may like to receive that lump sum payment that's tax-free so they can put that into the savings and use for other things. Do you want your income to keep up with inflation? An annuity payment can stay the same or increase each year. You will start with less money if you choose the inflation increases, but your income will be better protected against inflation over the long term. This is crucial because you may get this income for 20 or 30 years depending on your life expectancy. As a result of inflation, prices of goods and services have increased by 128.9% since 1991. Therefore, something that would cost £1,000 there may cost $2,289 now. You can choose to raise your income in line with that specific amount, potentially 3% or 5%. This is a good substitute for someone who is looking to counteract inflation but doesn't need exact inflation over the long term. How often do you want your income to be paid? You've got the option to receive your money on a monthly basis, a quarterly, semi-annually or annually basis, whatever suits your circumstances. Once your annuity is set up, you can choose to receive your income either in advance or arrears. Do you want your income to be continued after your death to your loved ones? No matter how long you live after setting up your annuity, you will continue to receive payments. Single life annuities will give a larger income, but the income will end upon your death if there's no additional features or guarantee periods. If you're married, living with someone, or you've got other financial obligations which are linked, you may want to make sure that your pension will continue to support those people after you pass away, especially if you feel they could suffer financially without you or your pension income. Your loved ones can choose to get a lump sum rather than the income after you're passing away, although these solutions will essentially lower your initial pension income, but it will give you that peace of mind and potentially increase the overall revenue that you and your beneficiaries take from your pensions. Your age will determine how your payments will be taxed after you pass away. Joint life annuities. When you pass away with a joint life annuity, this will continue to provide income to your surviving partner or spouse. What portion of income is paid will depend on the contract when you set up the annuity. A guarantee period, you can specify the minimum number of years for your annuity. Typically 5 years or 10 years durations are inexpensive. There are also options for longer, such as up to 30 years, really protecting that full retirement journey. Value protected annuities. A value protected annuity provides your beneficiaries with the money you've paid to the purchase price minus any income you've taken out it. Again, making sure that you're getting good value from the annuity. Could you qualify for a higher income? Choosing to be less healthy and active might actually benefit your finances during retirement in the case of an enhanced annuity. There's more than 1,500 health issues and lifestyle choices that might increase your income from an enhanced annuity. You may receive a lot more money going through this route just by declaring your characteristics that could make you qualify for that enhanced annuity, such as drinking alcohol, being overweight, smoking, high blood pressure, high cholesterol, potentially diabetes, heart problems, medication. They're all taken into account when thinking about that guaranteed income. Again, this will very much vary depending on your personal circumstances. Transferring pensions. Before transferring a pension, you should establish whether there's any fees or charges associated with this or any guarantees that you may be giving up by moving your pension away. These could potentially be very beneficial to you, such as a guaranteed annuity rate, which might be higher than the market, or a defined benefit that's giving you more benefit than the open market if you were to transfer. Lifetime allowance. The lifetime allowance is the maximum pension amount that you can accrue tax-free. It's measured at the final test at age 75 and when pension benefits are collected. All private and workplace pensions, including any pensions from which you are already receiving an income, must be considered. Unless you applied for protection with HMRC, you must pay tax on everything above the current lifetime allowance limit of £1,073,100. Applying for an annuity. There is a time restriction on the guaranteed for an annuity quotes, up to 14 days. The quote illustrates this. By the time the quote expires, the pension funds and related documents must be with those annuity providers in order to lock in that rate. Rates can and will fluctuate, often going up and down. You have the option to cancel, but you only have a certain amount of time to do that. Annuity is rarely able to be altered after it's established, so carefully weigh up your alternatives at the start. Only at the time of the application may health and lifestyle be taken into account for enhanced annuities. Your annuity and rate cannot be changed if your health changes in the future. The Financial Service Compensation Scheme serves as a safety net in the event that the annuity provider goes out of business and aren't able to fulfill their commitments. What are the alternatives? If an annuity doesn't sound like the right option for you, there's other income options for you, such as drawdown or taking lump sums from your pension in retirement. Additionally, you're not required to select just one option. For instance, you might want to convert a portion of your pension into that annuity to give you that steady income to pay for the bills, and you could leave the remaining balance invested in drawdown potentially so that you could still benefit from flexible income in the future. If you are approaching retirement and you're starting to consider the options available to you, we would always recommend seeking advice before committing to a decision. A financial advisor can walk you through the options available to you and provide you with a recommendation on what they feel is best given your circumstances and approach to investment risk. Retirement is something that you only do once, so it's important to make sure you get it right for yourself and your financial future.